Welcome to the Value Investor Chatter podcast. This is a podcast that helps you grow your wealth and become financially independent. My name is Beko, and I have today a very special guest, Rich Howie. Welcome to the podcast.
Beko, thanks so much for having me. This is fun. Excited to talk spinoffs.
Yeah, it's great. I have been a big fan of the spinoff strategy ever since I read about Joel Greenblatt. It's a really, and I personally was able to benefit from that strategy personally. And what you do is super interesting. So actually, before we do that, let me do a quick disclaimer. So everybody knows, listening to the podcast, we are not financial advisors. We don't know your situation. We don't know your tax situations. We don't know your financial situation. Definitely go talk to your financial advisor for any investment advice. This is not financial advice. Okay. Back to the podcast. So for those listeners that do not know who you are, could you give us a quick introduction?
Yeah, of course. Yeah. So I live outside of Boston, Massachusetts, and I am focused on investing in spinoffs, but also just special situations generally. I've always been more interested in areas of the market that maybe aren't as efficient. So generally, I'm not investing in large cap stocks, which a lot of people are looking at. A lot of really smart people are looking at. In terms of my background, so I was always interested in the market. So my parents were both in the market. My dad was on the stock. He was a portfolio manager. My mom was on the bond side. She was a bond analyst. And so I was always interested in the market. And so really took advantage of being able to ask them a lot of questions and learn a lot from them. But I, was interested in high school and college and the investment clubs and whatnot. I ended up starting my career at Eaton Vance, which is a mutual fund company in Boston. And I did equity research there and covered a few different sectors, completed the CFA program. And that was a great place to work. That place has since been acquired by Morgan Stanley. And then I think it was 2013 or 2014, I switched and moved over to Citi Private Bank, where I focused more on private equity research. And I was there for about 5 years. But I always had an entrepreneurial itch. And I was always interested in spinoffs and special situations. And so while I was at Citi, I started StockSpinoffInvesting.com, which was just an anonymous blog to cover spinoffs and research ideas that I thought were interesting. And then I eventually decided to try to make it a full-time thing. So I ended up quitting my job in 2018 and launched Stock Spinoff Investing Premium newsletter. And I've been focused on that ever since. And yeah, so that's a little bit of background. We can kind of dive into whatever's most interesting.
Yeah, this is great. So for those of you who don't know, there is this great website, StockSpinoffInvesting.com. I personally looked at it several times. I'm also a fan of the newsletter. Rich basically puts together this great set of resources for special situations, but most specifically stock spinoffs. And we'll get into what that is for those of you who don't know what stock spinoff is, but it provides, and I see on the website you have some case studies here. Stock spinoff recommendations have outperformed the market by a large margin. So here I'm reading the graph here. Stocks spinoff recommendations above 18%. And the historical average of S&P 500 is about 6-8%, somewhere around there. So stock spinoff provides really interesting opportunity for investors. So why don't we dig into what it is before we get into more of the details. So tell us about the strategy, stock spinoff strategy.
Yeah, definitely. So the basic idea, why I focus on this niche is because generally, as you've mentioned, stock spinoffs generally outperform the market. Not all of them outperform the market. In certain years, they won't outperform the market, and in certain years, they will. But it's an interesting area of the market, which a lot of individual investors like you and I, and also institutional, small cap hedge funds are interested in, because it's a potential source of alpha. And the main reason, I would say, what I find most interesting is when a large cap company means a company with a market cap of, call it $20 or $30 billion or larger, is spinning off a subsidiary that's very small. And so the cool thing about spinoffs is that, say you own 100 shares of a large cap company, and that company is deciding that it's going to spin off a small division, and we can get into actual real examples to make it more realistic. But for every 100 shares that you own of this large cap company, maybe you're going to receive 5 or 10 shares of this new small cap company. And for most people, that's kind of like a rounding error. You get this new company in your account that you've never really heard of. You didn't make an active decision to buy that company. And so the easiest thing to do is just to sell those new shares that somehow show up in your account. And even if you were to look up these new shares that show up in your account on Yahoo Finance or something like that, there's going to be no information out there. So it's hard to understand what exactly you own. And so the easiest thing to do is just to hit sell. And so a lot of individual investors and institutional investors, if you're managing a large cap fund and you get a small cap spinoff, by mandate, you're not allowed to own it. So you have to sell that spinoff. And so what it results in oftentimes is forced indiscriminate selling pressure. And so my whole strategy is you do the work ahead of time. Not all spinoffs are attractive, but if you do the work ahead of time and all the filings are pretty easy to find if you know where to look, you can do your own work and determine if you think this is a stock that you think is worth owning. And then hopefully what happens, and this doesn't always happen, but hopefully there is this indiscriminate selling pressure, and you're able to buy the stock, which you think is quite attractive, from people that are selling indiscriminately. So it's kind of like the perfect setup. It doesn't always work like that, but that's kind of what I'm looking for. That's kind of my ideal setup.
Perfect. So let me just recap for people. So it's basically the forced selling that occurs post the spin provides an opportunity. It creates this downward pressure on the price movement of the stock that is spun off, that it provides an opportunity for value investors who are looking to buy companies for cheap can actually get in there. And I think the point that you raise is interesting. It obviously doesn't work out all the time, but it's sort of like it's almost like a playbook, because these spinoffs gets announced 2-3 years in advance. Is that right?
Yep. Sometimes sometimes at least 6 months in advance, I would say, but oftentimes 2 to 3 years in advance.
Right. So it gives you ample time to do your own research and figure out if the thing that is being spun off actually contains a lot of value. Then it sort of can be a good opportunity to buy when the stock price gets depreciated because of the forced selling that happens. And tell me, Rich, the forced selling that happens, part of I think you alluded to it just briefly, the institutional investors that own the big cap.
Yep.
And they get a little bit of, the chump change of the spin. They are forced to sell because of the charter, because of the mandate. Maybe dig into that a little bit more if you can.
Yeah. So this is, I think, the most interesting thing, but like, I'll give you a really good example. So there's a company called Prudential PLC, which I think trades in London, but it's basically an insurance company with I think a big wealth management division. Everybody likes the stock because I think they have exposure to growing asset base and growing clients in Asia. And so the thesis, and Dan Loeb from Third Point recommended, and then the company agreed to spin off their US based annuity business. Annuities, kind of the backwater of finance. Nobody's really too excited about annuities. And so what happened was this large cap Prudential PLC, which is different from the US company, spun off this small cap company called Jackson Financial to British shareholders. So the majority of people are British or European that own Prudential PLC. They didn't ask for them, shares of this new company called Jackson Financial, which not only was it focused on annuities, which is the backwater of finance, but it also was a US-based company. So investors that are primarily focused on British companies have no interest in owning a US based company, never mind a small cap company. So a lot of times an ETF or an index fund or a mutual fund is focused on a certain market cap of stocks. Like you can buy a large cap, a mutual fund, or you can buy a mid cap. And so a lot of the natural owners of Prudential were not natural owners of Jackson Financial. And, you know, a lot of times these mutual funds have specific mandates, like you have to, maybe 95% of your portfolio has to be invested in large caps. You know, you can own the occasional small cap, but the majority of your portfolio cannot be in small caps. And so due to mandates from their shareholders, a lot of times these large cap portfolio managers are really forced to sell. And then other times there will be, as everybody knows, a lot of the ownership in the market right now is through passive funds like S&P 500 index funds and things like that. And so in other examples, the parent company might be a member of the S&P 500 and the spinoff will not be a member of the S&P 500. And so those index funds that have received shares of the spinoff are forced to sell those shares because they're not allowed per their mandate to own a small cap. I will say that we emphasize this doesn't work every time, but sometimes you see the key is you need two factors. You need the sell-off, the spinoff, the selling pressure, number one, and you want a business that you actually want to own. So in the case of Jackson Financial, I had done a work ahead of time. They file what's called a Form 10 information statement, which is similar to like an S1 for a company that's going public through an IPO, where it basically says, hey, here's our revenue, here's our earnings, here's how fast we've grown, here's the dividend we think we can pay. And so it allows you to say, hey, is this a decent business? Even though everybody thought that the annuity business isn't a great business, generated a lot of free cash flow, they were going to pay a big dividend. And so I said, hey, this looks like not only do I think there's going to be indiscriminate selling pressure, but it also looks like a business that I would want to own. Sometimes there's parent companies will spin off basically kind of what people call garbage barges, where it's a crappy company in secular decline with really high debt. And it's a company that I don't want to own no matter the price. So you can't buy them. You can't buy every spinoff. I mean, you probably would do fine if you did that, took an index fund approach to it. But I prefer to be a little bit more specific and more discerning and try to own the names that I actually think are good businesses at really cheap prices that are really driven by that forced selling pressure.
Mm-hmm. Yeah, I think the sort of baked in forced selling, it's just kind of a perfect opportunity for people that are actually willing to do the work up front to figure out the valuation, and then it just creates a nice opportunity. Again, I'm going to preface this all the time. Like every strategy doesn't work all the time, but it does present a good opportunity for sure. Can you tell the audience a little bit about the management when the spin actually happens? Because to me, when Joel Greenblatt talked about it in his book, to me that was one of the most telltale signs of where the value is going to be actually accrued. Because people that are running these ships, they know where the value is going to be accrued. They know which is a trash business and which is not. They're voting with their feet. So if, for example, if a CEO of the company, the parent company, decides that he actually or she wants to become the captain of the smaller ship, then it might tell you something about the value that might be unlocked in the smaller ship. So tell me a little bit more about that.
Yeah, it's a really good point. So I think Greenblatt says that, I forget what his top three things are, but basically incentives for him, I think, are the most important thing when looking at spinoffs. And I think Charlie Munger, has a similar outlook on how important incentives are. Basically, you follow the incentives and you follow, what's going to happen, or you have really good insight into, like you said, where the value actually is. And so, yeah, one thing that I like to look at is the management of the spinoff and where it comes from. Oftentimes, as you said, or not oftentimes, but sometimes the the management team of a big subsidiary will choose to go with the smaller division. And that's interesting because usually management, it's more prestigious to be at a bigger company that has bigger revenue and maybe is a member of the S&P 500. And so if you see a situation where the management team is going to the spinoff, it is sometimes a really interesting signal. Again, it doesn't work every time. I've definitely invested in spinoffs where the parent company went and it looked like a good setup and it didn't work out. So ultimately, the success of the spinoff is going to depend on how the business does. And it isn't crazy, and that's really intuitive to say. But like any company, generally the stock will do as well as the business does. And so, but sometimes it's a really good sign if the management team of the spinoff of the parent company goes to the spinoff. The other thing that's interesting to look at is Greenblatt always says to look for the amount of shares that are being reserved for executive compensation. And so say there's 10 million shares outstanding and you read through the Form 10 information statement that there are an additional 2 million shares that are available to be issued to the management team. That's a pretty good incentive. That's like 20% of shares, an additional 20% of shares that can be issued to the management team to incentivize them to create value. And oh, by the way, it's really more interesting if those shares, the strike price of those options are going to be struck when there's indiscriminate selling pressure. So that's another thing to look for. I would say most often, most companies most spinoffs, whether or not they're good opportunities or not, are fairly generous with their management team. But it is something that I like to look for. And then another thing that Peter Lynch was also a big fan of spinoffs, and one of the things that he wrote about in his book is look for insider buying. So if you have a recent spinoff with insider buying, again, it's the management team. They're probably getting a bunch of shares for free. They're also getting a salary from the company. But what if they're taking their hard-earned money and using that to buy shares in the open market? That's a really good indicator that there might be some potential value there. So I would totally agree with you that incentives are incredibly important to look at. Sometimes you have to read between the lines. So there was a company, microcap spinoff called Liberated Syndication. And if you look through the information statement, which shared how many shares the management team owned, you could see that the management team owned 0 shares. But what I thought would happen, and this is what ended up happening, was there was no investor relations effort. The company was incredibly coy with investors about sharing how good the business was doing. Basically, it was a podcast hosting business that was just printing cash flow and growing like crazy, trading like 3 or 4 times earnings. And my thought and was that management was probably going to grant themselves a bunch of shares. And the reason why they weren't promoting the story yet was because they wanted the price to stay low. And so that ended up playing out exactly as I had expected. So sometimes you got to read between the lines. It's kind of like being an investigator. You got to just like look for clues and try to read into the incentives of the management team. But yeah, I think incentives are probably the most important factor to consider when probably looking at any stock, but really definitely spinoffs.
Yeah, I love that aspect of it. It's sort of the management sort of playing this game a little bit. I think there's so much. I think there's so much alpha there because I looked at one of the spinoffs. We talked about it before we hit record, La Quinta, and the spinoff Corepoint. And one of the things that it's like 4 or 5 years ago, but if my memory serves me okay, I remember that there was some concerted effort. At least the sense that I got was that there was some concerted effort from the part of the management to kind of sandbag the numbers a little bit.
Totally.
And I think that's just a interesting point to look at because as that ties into one person said to me one time when I was kind of learning about this stuff, 10K and all these filings, you take them at face value if you want. But another lens to look at is they are in some ways a marketing material. So like really pay attention to in between the lines, like you said. I think that's, to me, that's so important to do as good investors.
So yeah, just to another just really interesting example, just that speaks to this. It speaks to everything that you just said. Is basically there was a recent spinoff called Fortitude Gold, and I forget the name of the company that it spun out of, but it was exactly what you just described, where the management team came from the parent company. So, and they came from a much larger parent company. Not only that, but the initial trading was definitely OTC, and it was on it was like gray listing OTC, and there was no reason for that to happen other than they wanted to discourage investors from buying the stock so that they could buy. Now you'll ask them the question, why did you do this? And they'll have a different answer for you, which will sound good. But the only logical reason why they were sandbagging numbers. Oh yeah, the other interesting thing is that they didn't in their I think they filed a Form 10 information statement, but they really didn't point to how profitable the business had become. You had to read the 10K of the parent company and then look and find the discontinued operations to figure out how much this company had actually earned. If you looked at the historical numbers, it looked like a mess. And the only reason to do that would be to be able to get more shares at a discount. So yeah, it's super important. And a lot of times these management teams are playing games where they're trying to sandbag numbers so that they can get lower prices on their options or give themselves a chance to buy more shares. And it's all legal, right? They can say, hey, we put it all out there in the form 10 and in the 10K and in the 10Q. And the other thing is it's not that complicated. I think maybe some investors will think, oh my gosh, you have to be a crazy good investor or analyst to figure out this stuff. It's actually not. You got to, when you're looking at spinoffs, you just got to look for obvious things. You don't have to, try to get, try to find some nuanced, crazy view. It should hit you over the head that this looks like a really good setup.
Yeah. Yeah, definitely. I the management piece I think is so interesting. When I was analyzing Corepoint, we actually did it in open, so it was like open for public, and we announced it, and then people joined. And actually, in the audience, there was some guy that actually worked at La Quinta, and he was like telling me about, oh yeah, this.
Oh wow.
And there was another kind of experienced banker in the audience. And he said, basically, look, you go to the bank and they'll tell you, this is a recipe. You got option number one, you can sandbag the numbers this and this and this way. Number two, this. And so they will present you with option on a silver platter. Just pick and choose whatever you want. And then, so they have it all sort of figured out. It's just, it's perhaps in some ways maybe cynical. I don't, depending on how you want to kind of view that, but it exists. I mean, this is what people do. So one question before we get into the actual names, because I'd love to get into some names that you're actually looking at now. One question that I have for you is the matter of timing, and it's sort of like maybe perhaps bad to say this, but because it's like timing is always so difficult to really nail. But what do you think about when we did the back testing of all of the kind of the stock force selling that happens after the spin? It looked like somewhere around 6 months to a year was when it sort of peaked, the sort of the global minima.
Mm-hmm.
Do you have some ideas around that? It's obviously different for different businesses, but any general rule that you have around when the peak actually is?
Yes. So there's many different ways to play spinoffs. So the name that we're going to talk about in a little bit is IC Inc., which I own and I like a lot, and I'm recommending. And it's basically a spinoff machine. So they've spun off I think 5 or 6 businesses over time. They incubate the businesses and then they spin them out. It's a sum of the parts story, and sum of the parts story can be deceiving because sometimes you never get the value. But in the case of IC, you get the value. So in the case of this name, I run a stock spinoff investing newsletter, but I'm recommending and I own this name because I think I know they're going to be spinning off these businesses over time. There's a ton of value, and we're going to get that value. So in this case, I'm waiting. I'm buying the stock before the spinoff, right? But in the case of my playbook, it's a great way to describe it, and that's how I think about it too. It's the indiscriminate selling playbook, and I probably get 2 or 3 of these a year, maybe if I'm lucky, where it's a good business and it's going to be sold indiscriminately, and we get a really good opportunity to buy it. Let's see. Contour Brands was an example of this, and then Jackson Financial is the most recent example. What I typically look for is at least, basically, you want at least 50% of shares outstanding to have traded. So generally, I've looked at past situations where there was indiscriminate selling, and what I found was usually the stock bottomed after 40 to 60% of shares had traded, and that also corresponded to about 7 or 8 trading days. So typically, and the way that you can find this out is the Form 10 information statement will tell you how many shares outstanding the company has, and then you can go to Yahoo Finance and type in the ticker, and you can find the shares traded per day. And so I just add them up. And so basically, generally, I'm not looking, if there's indiscriminate selling pressure, you don't want to get you can't time the bottom perfectly, but you want to get in towards the end of that. And so generally, I'm looking for at least 50% of shares outstanding to have traded. And that generally corresponds to waiting at least a week, usually 7 or 8 trading days.
That's a great insight. Yeah, that's a great insight. Awesome. Let's move over to the actual names. You dropped a few during the podcast, IAC, and then this one, Unit Corporation, before we talked about it. But let's go one by one. So what excites you about IAC specifically? We'll start there.
Yeah, definitely. So IAC is a name that is a conglomerate. So oftentimes conglomerates are good areas for potential spinoffs because there's a lot of inherent value, but usually a conglomerate will trade at a discount to its sum of the parts valuation. And so the interesting thing about IAC, and it's actually IAC was written about, Barry Diller was written about in Joel Greenblatt's book, You Can Be a Stock Market Genius, which I would recommend as my favorite book of all time if you're interested in learning more about special situations and spinoffs. But Barry Diller is still the chairman of IAC Inc., and a big reason why I like the stock is related to his involvement. He's a very good capital allocator. He's very good about knowing when to buy stocks, when to sell them, and he has a very good track record of unlocking value. So I think, I don't know what the exact numbers are right now, but over time, IAC has compounded at something like maybe 14 or 15%. Looking back over the past 20 years, beating the S&P 500. And if you look at the stock of IAC, it doesn't look, especially right now, it doesn't look that attractive. But what you don't see with IAC is the assets that they've spun off. So TripAdvisor, Expedia, Vimeo. Let's think what other names have been spun out. Match.com. A lot of other names have been spun out of IAC because that's really their playbook. What they do is they can build companies from scratch, they can buy minority stakes in companies, or they can buy majority stakes of businesses, help them grow, and then eventually spin them out. And so their playbook is basically this. We know their playbook. They build businesses, they buy majority stakes, they buy minority stakes. They help those businesses grow, and then eventually they set those businesses free. The most recent businesses that have been spun off was Vimeo. in Vimeo, if you look at the stock chart, it looks like an absolute disaster. But I think the interesting thing about IAC is that it basically built this business from scratch and then spun it off at a 15 times revenue multiple, right? Joey Levin, who's the CEO, was like, listen, the public markets last year are paying crazy multiples for these SaaS type businesses. We're going to take advantage of that. So you as a shareholder, they said, we're not going to make a decision whether or not it's good to sell Vimeo or not, but we're going to spin that out and you can make whatever decision you want. So they're very good at recognizing value, where there's opportunity, where there's not, and then just spinning out those assets when those assets are ready to be to stand on their own. And so, and then IAC, I think, has also really been a company that value investors have loved for a long time. But interestingly, it's out of favor now, which is just interesting to me because investors seem to always be really enchanted with Joey Levin, the CEO, and with Barry Diller, the chairman, and their ability to create value over time. But the sentiment on Twitter has gotten a little bit better, but it's still way negative, way more negative than I've ever seen it for this name. And the story of IAC right now is a sum of the parts story. And the thesis is the stock, I think, very conservatively, is probably worth $85 a share. I think this morning it's trading at about $55 per share. And so the thesis is that we eventually, all these assets that are very valuable and attractive are going to get spun off to shareholders. And why do I have confidence that that's going to happen? Because that's happened, because that's just in their DNA. That's just what we've done. They've spun off the Lending Tree, Vimeo, Match Group, Expedia, TripAdvisors. There's just been a bunch of examples of them doing that, of them monetizing their holdings. So I know I spoke for a little bit. I can pause, or I can get into exactly what they own and how I think it's value. Whatever would be most helpful.
Sure. Let's get in. It sounds like there's a theme here. TripAdvisor, Vimeo, Match.com, Lending Group. It sounds like it's a lot of kind of tech adjacent or tech names.
Yep.
So tell me about their overarching thesis, and then let's get into some of the actual names underneath that umbrella.
Yeah. So that's a great. That's a great point. And I would say tech adjacent names, but also businesses focused on two-sided marketplaces. I think that's their primary focus. And like Match is a perfect example of that. TripAdvisor is a good example of that. Let's see. And then the other, and then Turro. So Turro is basically the Airbnb, but for cars. And they're going to be, they own 27% of that. They have warrants to buy more. That's a beautiful two-sided marketplace business. It's like Airbnb, but if you want to rent out your car, they're the far and away market leader. So I'm very excited for that. Not only is it a fast growth business, and I know fast growth businesses have kind of come back down to earth, but the cool thing is that it's really profitable. So they print earnings and they grow really quickly, but they still are able to generate free cash flow and earnings. So I think that business is really good. And it's also an example of a marketplace business. So very good point there. And then they also own a majority stake, about 85% of Angie Home Services. And this is the one area where they've missed. So this is a marketplace business. If you search, I need a plumber, odds are that you're going to get an advertisement from Angie Home Services or another subsidiary that Angie Home Services owns to help match you with a plumber in your area. This business I've never been particularly excited about, just because it's such a complicated story. They're trying to basically help you find an electrician, a plumber, a carpenter, somebody to mow your lawn, somebody to rake your leaves. And it's just, there's a lot of moving pieces here. When you look at a business like Turro versus Angie, Turro is simple. It's like you have somebody who wants to rent cars and somebody who wants to rent you those cars. And Turo's the middleman in between those two sides of the marketplace. And you're not going to be able to find somebody to rent a car in Florida if you're going to Florida, unless you use somebody like Turro. If I want to find a plumber, I can text my neighbor and be like, hey, I have a clogged drain. Who do you recommend, right? So I think it's just a much more complicated story, and that's the one area where IAC has missed a little bit. But having said that, I actually think Angie is pretty cheap right now. It's trading like 9 times. It's growing like crazy still. It's trading. They've made some mistakes. They've invested in growth, overspent. But if you look at their normalized kind of run rate free cash flow, they're only trading at like 9 or 10 times annualized free cash flow, looking at pre-pandemic levels. So it looks like a very low-cost call option, I guess. So basically, just to run through the math, IC owns over 400 million shares of Angie. That's worth, let's pull up my sum of the parts model here. That's worth about $1.1 billion right now. IC also has about $1.6 billion of cash. IC also owns Turro, which is the car rental Airbnb, but for cars business, which I valued about half a billion dollars. They own a business called Care.com, which if you're a parent, you might be familiar with to get help with babysitting and other childcare. They acquired that business, took it private, and it's grown. I think revenue's grown about 70% since they've acquired that. I'm still valuing that at their acquisition cost, which was $500 million. They have a business called Vivian Health, same theme. It's a business that helps healthcare companies hire healthcare workers. Marketplace business growing incredibly quickly. That's valued at about $300 million. They own about 75% of that. And they also, this is kind of different, they own MGM. This is a large cap business, which is primarily a casino business, but it's investing heavily into the digital betting world. And there's some hidden asset value there. And Angie thinks that they first started buying the stock in the 15s. I think MGM's close to over $40 right now. So that's been a very valuable investment for them. It's a minority investment. They only own about 15% of shares outstanding, but it's almost worth $3 billion right now. Then they have some debt, $2 billion of debt. They also have their Dotdash Meredith business, which the Meredith business was a recent acquisition where IAC basically bought the digital assets from People Magazine, and IAC has a core competency of improving web assets. People's Magazine is not a very good. Their core competency is not really running and optimizing web views and search engine optimization and things like that. And so IAC really has a good business model and a good approach to really improving the performance of those assets. They also merged that business with Dotdash, which is their web business. They own sites like Investopedia, which if you go and look up, what's enterprise value, what's market cap, you can find all sorts of information on that in a way that's not obtrusive, and you don't have tons of ads, and it performs really well. So there's a ton of value here, and I know I've moved really, really quickly here, but the thing that I like about this is that there's just a ton of ways to win. If you add all this up, it's worth, easily probably $85 a share. The stock trades right now at $55. Usually the bear case will be, it's a conglomerate, so it should trade at a conglomerate discount. And it will. IC always will trade probably at a conglomerate discount. But the difference here, the key difference, is that you have really good capital allocators running the business, and that eventually we're going to get access to those assets. They're going to get monetized, or they're going to get spun off over the next 1 to 2 years. So that's kind of the thesis in a nutshell. But I know I moved pretty quickly, so happy to answer any questions that you have.
No, that's a great list, and thanks for running through them. Obviously they're great. They have track record of nurturing these businesses, making them more capital efficient, blah blah blah, and then spinning them out and capturing some value. That catalyst moment, the moment at which they actually capture that value, sending Vimeo into the public market. The actual mechanism of it, it sounds like some of these are, publicly traded. They have some minority or majority stake in the company. What is that? If, taking private company and then sending it out to the public market, that's one way. Spin, another way. what is the value capture mechanism for some of these businesses that are just, already public? What does that look like?
Yeah, so that's a great question. So with Match, I believe they acquired Match and then grew it like crazy, and then they IPO'd 20% of the business in I think 2015, and so they owned 80% of the business, roughly, rough numbers, through the pandemic, basically through 2022. And then they decided that, hey, Match is a huge company, generates huge revenue, huge growth potential, massive market. It's ready to stand on our own. So we are going to spin off the remaining 80% stake that we own of Match into to our IAC shareholders. And we're basically going to set Match free. Angie, they own about 85% of, but Angie's really stubbed its toe. It's changed strategies a bunch. Actually, Joey Levin, who's the CEO of IAC, has now stepped in as IAC or Angie's CEO to kind of try to turn the ship around. But they don't think that Angie's can stand on its own 2 feet. It probably could stand on its own 2 feet, but they think that Angie can still is still should be nurtured within the IAC umbrella. A company like, let's think, a company like MGM, that's very different. So IAC typically just buys small companies, minority or majority stakes, makes them grow, and then spins them off to shareholders. But with MGM, it's a big company. Like, I don't know what the market cap is, but it's a very large company. But I think the thesis there is that IAC thinks that there's a lot of embedded value, especially with the new massive, with betting being legalized, sports betting being legalized in the US, and BetMGM's a big brand in that market. And that's currently generating losses for MGM. But it's so on a consolidated basis, it makes MGM look expensive. But it's actually a really, really valuable asset. And so that's the bet there. And it's very different, but it's kind of like you're basically kind of giving your money to Joey Levin and IAC and saying, hey, allocate it as you see fit. They are going to make some mistakes, like they made some mistakes with Angie, but more often than not, they're going to create value in the best way that they can. And there's no plan right now for MGM or for IAC to spin off MGM. But I would think that once MGM gets to a valuation that IAC thinks is fair or maybe expensive, I would bet that IAC would just spins off its stake in MGM to shareholders. They're very tax efficient. So if they were to just sell shares in the open market, they would have to pay a lot of taxes, but they do everything that they can to avoid paying taxes and just shifting it to you. They would probably spin it off in a tax-free transaction, which would avoid taxes altogether and allow you as the owner of IAC to make shares of what you make a decision of what you want to do with your MGM shares. So it kind of varies. Sometimes they'll sell the asset outright, but more often than not, they'll just spin it off or merge it and spin it off into another public company.
That makes sense. Awesome rundown of IAC. And Rich, you have all of this detail on your website. Is that right?
Yes, exactly. Yep.
Yeah. So definitely go check that out if you guys are interested in learning more about IAC. Let's quickly run through the special situation that we want to talk about. UNTC, that's a ticker symbol, Unit Corporation.
Yeah. So when we were doing our pre-prep here, you mentioned that a lot of your audience is based in the South and has an interest in oil and gas names. And I personally think that we're in a period that's set up extremely well for oil and gas. Typically it's not smart to buy cyclical companies like oil and gas names at very cheap valuations, because typically you want to buy companies when oil is you want to buy oil and gas names when oil is at negative $40 and they're not generating any revenue or any profitability. But I think what's different this time is that there's so much focus from investors on ESG concerns and decarbonizing the world that they've kind of forgot that, for the foreseeable future, we're going to need oil and gas to power the world economies. And we're going to be using oil and gas for a lot longer. And to create more oil and gas, you need to invest to drill new wells. And if you look at just CapEx over the past 10 years, Bernstein has a great chart on Twitter. Send me a DM on Twitter and I'll send it to you. But it just shows that there's been typically when prices rise, you see a massive spike in CapEx, meaning there's a supply signal. There's a signal from the market. Hey, we need more investment in oil and gas. And so CapEx spikes so that there's more oil and gas to go around, and then the price inevitably falls. But what's happened here is even though oil and gas prices are relatively high, CapEx has stayed very low. There's been no increase in CapEx because oil and gas companies they've been berated by their shareholders. Hey, don't just spend money to drill wells, return that cash to us, pay us big dividends, buy back your own stock. And so I think that's a setup for continued positive performance for oil and gas names. And one name that I like a lot that I own and I'm recommending is a company called Unit Corp. And it's basically went bankrupt during the pandemic, but because it had too much debt. But it's basically a diversified energy, oil and gas name. It is not a spinoff. So I'm looking I invest in all the ideas that I recommend. And so it doesn't have to be a spinoff for me to recommend it. I just want to find the most attractive names, and Unicorp is definitely a top 3 high conviction idea for me. And but it is a special situation because it came out of bankruptcy. It's still trading over the counter. No index funds own it. Nobody's really heard of it. I mean, if you search for $UNTC on Twitter, there's some really good write-ups which can get you up to speed. But nobody really, no big fund managers own it. It only has like a 500 million market cap, or maybe even lower than that. And it's a really under the radar name, and it's trading over the counter. It's a post bankruptcy name where a lot of the debt holders that got the equity in exchange for their debt now own stock. They're not a natural shareholder base for stock, so they're probably going to be looking to move on over time. But I think that has helped keep the valuation on Unit Corp very low. The high level thesis is that this is a diversified energy company that has an oil and gas drilling operation, which has been profitable. It has a drilling rig operation, so it has these very extensive, very difficult to manufacture drilling rigs, which are in incredibly high demand right now, that are being rented out at $35,000 per day. And these things are just printing free cash flow. And then it has a midstream business, which gathers and stores and transports oil and gas. And the thesis at a high level is that the stock is just dirt cheap. So despite uneconomic hedges, so coming out of bankruptcy, the debtors made the company put on very conservative hedges to ensure that the company would stay profitable even if oil went back to negative $400 or negative $40 a barrel. And so over the past couple of years, the company has printed free cash flow despite the fact that it's had these negative economic hedges. So the good news is that the majority of production this year is not hedged. And so free cash flow is going to be a lot higher. It's going to explode higher in 2023 than it was in 2022. But if you just look at how much free cash flow the company generated this past year, it generated, I think on an annualized basis, they haven't reported year-end numbers, but I think they're on track to generate about $130 million of free cash flow. And the stock is trading, I don't know what the market cap is, but it's under $500 million. So it's trading, right around maybe probably under 4 times free cash flow. And they also have, I think, about $80 million of cash. So their enterprise, they have no debt, I think $80 million of cash. So their enterprise value is even lower than their market cap. So it's trading at about 3 times on a enterprise value divided by free cash flow level. And free cash flow is going to grow next year. Then you have high insider ownership. You have a company called Prescott Capital Management, who I think own the debt. It got converted into equity. Best trade ever because I don't think they've sold any shares. They're on the board and they're incentivized to do what's in the best interest of the shareholders because they are a shareholder. So who knows, some assets could be sold and monetized. The other nice thing is this company is just returning cash to shareholders. So since they've gone public again, they've bought back over 20% of shares outstanding. So that's in 2 years. And then they just paid a $10 special dividend. and they announced they're going to be paying a $2.50 dividend per quarter going forward. So right now that works out to a 20% yield, 20% yield of cash that they're paying out. They did say that they're going to take this quarterly dividend on a case-by-case basis. So if they need to cut the dividend, they will. But for the foreseeable future, they're paying out $2.50 per quarter. That works out to a 20% yield, which is just a little crazy. The thing that I love about it is that you have the downside protection, right? They have net cash on the balance sheet. They have no debt. They do have some production hedge, but the majority is not. And then you have this backdrop of no capex in the oil and gas market. So there should be some nice cyclical, tailwinds. We might go into recession, who knows? But even if we do go into recession and it's short, it's probably going to be, short-lived. The world is going to continue to need oil and gas for the foreseeable future. And so I really like this name, despite the fact that it's been a really good performer. It's up a ton, and I'm a little bit late to this name, but I do continue to have a lot of conviction in this name. Not a spinoff, but it definitely would qualify, I would say, as a special situation.
Amazing. That's pretty incredible. I have never heard this name, and I'm going to go and definitely take a look. What is, just one last question on this company.
Of course.
Do you have any capital inflow catalyst on the horizon?
Yeah, so the short answer is maybe. So the company, a lot of investors have asked about a potential uplisting. So this company's traded over the counter. No Vanguard funds own this. No ETFs own this. So theoretically, you could uplist this company to NYSE or something else, put it on the radar of more investors, and get capital flows. I don't know what those capital flows would be, but theoretically there would be some buying pressure on the stock. I didn't even ask management about this, but they did mention that it's on their horizon, that it's not imminent, but it's probably something that they will think about doing. The thing is, when you do uplist, you got to pay NYSE, I don't know what it is, but you got to pay them $1 million or $2 million a year. There's more costs to maybe directors and officers insurance and things like that. And so there is a cost, but I know the management is evaluating whether that makes sense to them. So I would say that is the biggest capital flow potential catalyst, but I don't know. I think probably it happens at some point, but I just don't know timing wise.
Okay. Awesome. This was an excellent rundown. And again, if you guys are interested in this name, definitely check out Rich, his newsletter. Go check it out, stockspinoffinvesting.com. All right. This has been an excellent podcast. Where can people find you?
Yeah, so I'd say, like you said, stockspinoffinvesting.com. So check out my site. I do have a spinoff calendar too that you can just check out the upcoming spinoffs and how the old spinoffs have performed. And then also I'm on Twitter. So I think I'm you can search for Twitter, Rich Howe, and I should pop up. Or my actual handle is at Stock Spinoffs with 2 S's. Stock Spinoffs was taken, so I had to go with Stock Spinoffs with 2 S's.
Nice. Awesome. Well, this has been great. Definitely go check it out. We will be in touch over Twitter.
Awesome.
All
Beko,
right.
thank you so much for having me on, man. This is fun.
Yeah. I'd love to have you again. All right.
Anytime.
Thanks, guys.